back with your weekly Money Minutes. We bring you these weekly videos just to give you some common sense advice when it comes to your own personal investing and financial life. Now, this is part 4 of our tax series, where we really just want to focus on ways that you guys can save money in your taxes. Let's be honest here. Taxes are inevitable. We do have to pay taxes, but there are ways of optimizing that, and especially in the future, making sure we can minimize that. And that's really what we want to focus on today.
Yeah, you're gonna pay taxes, but if we can mitigate it any way, shape, or form, that's a huge advantage for you as an investor, as you're saving for your path to what we call your financial freedom. And one thing we talked about, going full circle back to the first video in this series, is the importance of contributing to your 401k. Like we said many times, it's one of the only deductions you have left, especially if you live here in New York City or New Jersey, Connecticut. I mean, we get creamed with taxes. The 401k is a great way to do it. Now, Courtney, I remember several episodes ago of this show, we talked about, do you max out your 401k? And you said you don't max out your 401k. And I'm like, you're a financial advisor. So why don't you max out your 401k? We all want to know.
And that's what we're going to explain today. And the big difference here is taking advantage of your Roth 401k, which most employers do offer. Your 401k, I did take your advice when I started up at our company and I added to my 401k as one is supposed to.
I'm flattered.
Now, you get a deduction on that right now. But what's gonna happen is that money is gonna grow and grow and grow, and you never pay taxes on it. And you're gonna pay taxes when you retire. Now, the younger you are, theoretically, the more that money is gonna grow. And so that can be a big lump sum that you're paying taxes on down the line. On the flip side, you can add to a Roth 401k. So you pay the tax now, and there's no benefit right now. I'm gonna pay on that income.
Right.
But that money is then gonna grow and grow and grow. And no matter what has grown to, I'm never gonna pay taxes on that money again. When I did this math, I said, you know what? I'm young and early on in my career, and that made more sense for me.
Right, so the nuance here, and the important thing is, you wanna decide, are you a higher earner or are you a lower earner right now in your career? And tax brackets actually came down last year, so you got a tax break. So depending on what tax bracket you're in, and let's just say on the lower end from 24% or down, you're probably not getting a great deduction anyway. It may make more sense. Do the Roth 401k, to your point, like if you're like Courtney and earlier in your career, but when you're making more money later, maybe in that 34% and higher bracket, it's time to move over and do the actual pre-tax 401k contribution. But how much you make is the key variable here, and that's what you have to decide when deciding between a Roth 401k or a regular 401k.
So a Roth 401k has the same limits as your regular 401k. If you're under 50, you can put up to $19,000 a year away into a Roth or a regular 401k. Now, let's say that I put $19,000, I'm maxing out my 401k, traditional 401k. That's a tax savings of about $4,700 if you're in a 25% tax bracket, which is a good chunk of change you're saving right now.
Yeah, it's real money.
Exactly.
Yeah.
Now, if I add $19,000 to my Roth 401k, I am not getting that $4,700 of a deduction. So the key when it comes to your Roth 401k is the growth you're gonna have over time. So that $19,000 in both accounts here would grow in 35 years from now to about $150,000 at a 6% rate of return. So essentially, you put in $19,000 now, you're gonna make another $130,000 on the growth of that over 35 years. In a regular 401k, I never paid taxes, so I gotta save $4,000 in my pocket this year. However, now I'm retired 35 years from now, and that $19,000 has turned into $150,000, I pay tax on that entire $150,000, which is a lot of money down the line.
Yeah, exactly. So again, this is why it's so critical to know what tax bracket you're in, because right now you may not need that deduction. That $4,000 plus that you would pay, that you save in taxes, is not as meaningful potentially as the huge savings of that big bucket of money you're gonna have later that's completely tax-free. As always though, you wanna consult with your accountant, a financial advisor, to make sure you're doing this the right way, but doing this the right way can be a huge difference in the amount of taxes you pay over the next 30 years. Okay, so you're probably thinking to yourself, this is amazing. Why don't I know about the 401k Roth? Well, guess what? You may or may not have it depending on what your company offers. So talk to the HR or human resources person and they're gonna let you know if you're eligible for this or if they have it in their plan. If they are, it doesn't matter how much money you make, you can choose between doing a regular 401 contribution or a Roth 401k contribution, or even get crazy. You can do some that's a Roth contribution and some that's a regular 401k contribution. And this is where it's helpful to talk to your tax advisor to see what's best, or if you have a financial advisor, they can help you run the numbers as well. But this could be a huge opportunity for you. We don't want you to miss out on it. Talk to your human resources today since you've seen this video. And if you like our videos and you find this content engaging, you can subscribe. We have our YouTube channel. You can click on the link below. Or if you know somebody that would benefit from this kind of content, please forward this along. That's this week's Money Minutes. As always,
Be bullish.